One of the best restaurant companies out there is Portillo's, but the stock has not been a huge success for investors. Shares are down about 73% since the company IPO'd in 2021 and actually went further in the wrong direction last week after the company reported earnings. But I don't think the results were nearly as bad as the market's reaction. And this is actually a stock that's now getting into a nice value territory. There's a ton of growth potential ahead for Portillo's, expecting to grow 12 to 15% in the number of restaurants that they have. It still has a cult following, phenomenal economics on a per restaurant basis. But now it looks like that valuation has gone from being probably extremely overvalued when they IPO'd to a really attractive level for investors. So I'm going to dig through the numbers in the recent quarterly report, kind of put it in the context of where we are from a stock standpoint. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get right to the recent numbers. I'm going to just start here with a high-level performance overview. And this chart with the yellow columns is really what investors were focused on last week. You never want to see a drop in same-store sales because that really shows weakness for a company, and that's where you're getting your operating leverage. So your costs to hire staff, to have a location built, have all the equipment inside, that's all fixed. So you want to have that revenue on a per store basis continue to grow over time. That increases your profitability. But we have seen obviously that revenue was down a little bit last quarter. Management blamed that a little bit on the weather. What's a little bit strange with the restaurant business is if you have a really bad cold streak, which was the case for Portillo's, and it impacts your sales for a week, that can actually impact an entire quarter because you don't get those sales back. It's not like a pair of shoes where somebody's just going to buy a pair of shoes next week. We're talking about food. You either buy it today or you're not going to buy it at all. So I don't love that excuse, but I just want to put that into a little bit of context. But keep an eye here on what they call the 2-year comparison stack. That is maybe a little bit longer term view of what's going on. You can see that growth is 7.8% when you put it into that kind of context. So people coming back out after the pandemic, going out to eat more, and now we're starting to see the opposite side of that, which is just kind of pulling back a little bit on that spending. So it makes sense, I think, long term. These are the kind of ebbs and flows that you have in businesses, but not every company is seeing the same impact on their same store sales. So that's where some red flags may have gone up. But we are at a point where they're pretty profitable. $10.1 million in operating income, $5.3 million in net income. That's despite the fact that they're investing a lot of money in expanding their capacity. Going to build 9 restaurants in total this year. 1 is already completed. 8 will be done throughout the rest of the year. And then restaurant level adjusted EBITDA. This is the number to watch with Portillo's, $36.4 million. They had 85 restaurants operating in the quarter. So this puts them about on a runway, if you look at the numbers overall, to $2 million per restaurant in adjusted EBITDA. So that makes the numbers really nice to look at from a valuation perspective, which I'll get to in just a little bit. This is that 9 units that they talked about opening. The one in Denton is already opened up, and then it's going to be pretty backloaded. Again, here's the trends, and I think this is always the way to look at a company like this because there are going to be ebbs and flows in not only the restaurant level revenue, but also your costs. So one of the questions they get a lot on the conference calls is, what do commodity costs look like? And commodities are going up. That means that prices are also going up. That's putting pressure on consumers. Those things will even out over time, but on a quarter-to-quarter basis, there's going to be a number of impacts. So revenue continues to climb, maybe not climbing in the way that you would expect for a high growth stock, but like I said, they're going to be adding 10% more restaurants this year, so we'll see this pick up throughout the rest of the year. Operating income moving in the right direction, same thing with net income, and adjusted EBITDA margin hovering right around 15%. This is the one that I look at, restaurant level adjusted EBITDA. And you can see in the last 12 months, $167 million. You just divide that by 85 restaurants, and that's how you get to about $2 million per restaurant. But what they're expecting to do, if you look at the bottom here, is grow the number of restaurants 12 to 15% per year. That's really where you're going to drive your growth for Portillo's. So what we need to see is these restaurants actually opening up, but that's going to take a little bit of time. They have talked a lot about this, that they basically have to build the muscle to be able to do this on a regular basis. When you get into expansion mode in restaurants, there's things that you can do once and then repeat over and over and over again. You start to build scale in certain regions. But it takes time to do that. And that's the phase that I think we're in with Portillo's right now. They have a lot of scale. They have a lot of expertise in the Chicago area. Now what they're doing is they're expanding in the Sun Belt. Well, now you need to, one, learn how to design and build restaurants for that area. Then you need to repeat that the next year, keep expanding in the areas that you're building. Now your infrastructure and your supply chain is going to be a little bit more efficient. Now your margins are going to go up. Your awareness is going to go up. Your advertising dollars are going to go further because instead of having one restaurant in the city, you're going to have 4 or 5. So all of these things will play out over time, but again, we are in this investment phase. So what I think we want to see is solid profitability at existing restaurants and then a steady clip of restaurants being added each year. So this is exactly what we're seeing. And if we see 12 to 15% unit growth over the next decade, this could be a phenomenal stock because Portillo's is a pretty good value. If you look at their long-term debt, $282 million worth of long-term debt. There's a little bit of short-term debt in here. Add to that the market cap of $740 million, and you get a little over $1 billion, depending on the day, or $1.1 billion worth of enterprise value for Portillo's. What are we getting for that? That's where you look at this $167 million in restaurant level adjusted EBITDA. And so you're paying about 6.5 times restaurant level adjusted EBITDA. I think that's a pretty good valuation for a company like this that's expecting to grow in that 15 to 20% range when you add together both unit growth and then some single digit same store sales growth long term. So the growth story is there. It's a little bit lumpy. But now the advantage is, after the stock has dropped, you have a much more attractive valuation than you had a year or 2 years ago.
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
So it would obviously be great to see restaurant level sales grow 5-10% every single year, but that's just not the case. And a lot of times what Portillo's is running into is just efficiency. They're extremely busy at their busy times of the day. So this is, again, one of the things they talked about on the conference call is that they have gotten a little bit slower in the drive-through. So they're going to push more speed through the drive-through over the next few quarters. Expect that to be something that they talk about again. And if they can do that, then you're going to be able to generate more sales on a per restaurant basis. But I don't think there's anything fundamentally broken about the company. What's really changed over the last few months in the last couple of years is the valuation. And I think this is a very well-positioned company, really attractive economics. I mean, they're doing $2 million worth of adjusted level EBITDA. Chipotle only does about $3 million worth of revenue per restaurant. So that just gives you a little bit of a comparison to what the economics look like for this company. What they need to do is now keep expanding the business, keep building out that scale in the Sun Belt specifically. As they do, these economics will get better over time, but definitely not something that I'm worried about long term. And now, given the much more attractive price for the stock, I'm definitely going to be adding. The other thing I want to add is that they continue to buy back B shares from their former private equity owner, Berkshire Partners. So that's another overhang that has been confusing in the stock. And I think a lot of investors, when you look at the share count outstanding, a lot of times that's not included. So it looks like shares outstanding are just exploding, but they're not really. What they're doing is they're issuing A shares to buy back those B shares. That process is almost completed. So I wouldn't be surprised if Berkshire Partners or those B shares are basically out of the picture by the end of 2024. And that would be definitely a positive because it just makes it a little simpler to look at Portillo's as a stock. But what do you think about the results of Portillo's? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.